next guest, surprise, surprise, also thinks it's worth buying into the Chinese consumer story as well, especially as retail sales continue to remain strong on the mainland while dropping off elsewhere around the world. And she happens to be the #1 rated analyst on Anta Sports. And if you had followed her advice, you would have made returns of over 200% in the past 12 months. We have Jessie Chen, Senior Analyst for China Consumer Research at Macquarie Securities, rejoining us once again here on The Edge. Nice to see you once again, Jessie. So let me first ask you, this resilience in China's spending, as we've been reporting, how long do you think it's going to last, considering we still have this massive stimulus package being filtering through the economy?
I guess as long as the income growth continues at the current pace or potentially accelerate, the fundamental drivers are still intact for Chinese consumer sector to grow continuously.
Yeah, but you have concerns about inventories. As with most other places around the world, retailers do have high inventories at this point because they're not selling it as quickly as they used to.
They expected. That's right. Especially in the mass market, and that's what we've been flagging into the recovery, because the recovery is driven by primarily liquidity and investment. We prefer the high end over mass market, partly because of the margin issue. A lot of the export capacities over the past half year or year have been shifted domestically, and that has created some inventory issues. And as you see, particularly in the sportswear sector, there has been inventory issues, and as a result, margin pressure over the past 2-3 quarters.
Yeah, it's very interesting that you say the high-end part of the retailing sector will recover or is doing better than the low end, because when you think of China, you think of all these people who make under $1 a day, so that is pretty surprising news.
Like I said just now, longer term, you're right, the more structural growth will be coming from the mass market, but that's more of a long shot in the next 12 to 18 months, I think, because the recovery in China is driven primarily by liquidity and investment. High-end would definitely rebound more quickly, and also in terms of margin resilience, those guys are a lot more disciplined in terms of discounting, etc. So we're going to see stronger growth from those high-end plays.
Yeah, well, Jessie, as you saw on the screen earlier with the graphics, that the retail sector, the consumer stocks, are really the second best performer in the MSCI China Index, also on the Shanghai Composite. With all this run-up, do you think maybe it's time to do some profit-taking for investors?
You make a very good point here. Actually, a lot of the valuations at the current levels have shot through our target prices.
Yeah.
I think in the near term, leading to the results season, there will be some volatility in the sector's performance due to pretty choppy data flow, and that would present, I think, potentially a better entry point.
Oh. Well, one of these that has already shot through your target price is Golden Eagle. This is a retail group that owns Chinese department stores across the mainland. And it's interesting because this is your top pick. Golden Eagle is. Looking at its PE ratio on the Bloomberg system, we saw that it's actually more expensive than its peers and above the Hang Seng members. What makes this stock worth buying into, in your view?
Department store in general is trading at a much higher PE level because of the risk profile. It is a much less risky segment, partly because they don't have inventory risk. And a lot of them, especially the likes of Golden Eagle and my other top pick, which is Lifestyle, they own the majority of their properties. So all of these provide a pretty strong buffer in the downturn. And on the way up, because they're high-end, they're I guess for investors who are looking for leverage, those are the best choices. And within high end, there's, to be honest, very few quality choices in that segment in China.
What about Parks and Retail? That's a pretty high end store as well. It also has its foothold in bigger cities.
Yeah, it's the largest department store chain in China and probably one of the oldest as well. But it's not really that high end. It's more towards middle segment.
Okay, so you're looking more for the high end. But let's talk about the target prices. As you mentioned, a Golden Eagle has already overshot the price that you had expected. Trading at $9.81, you were expecting $9.20. So are you saying to investors, as you say, there may be better entry points further down the road to maybe sell off now and buy into when the price gets lower?
Yeah, absolutely. At the current level, I wouldn't be too enthusiastic about the likes of Golden Eagle. Long term, it's a great growth story, but in the near term, I think for the sector in general, there will be some corrections leading towards the results season.
Well, let me just ask, what's a good entry point for Golden Eagle?
Look, even at my target price, which is about 920, we're talking about 20 times 2010 PE. It's not that expensive against the growth potential, which is about 25%. I think that's still it'll still be worth buying at that level.
Okay, at that level, at the target price right now for a long-term hold.
That is right.
Okay, you're not going to make money this year if you're going to buy in at 920 or 980 at this point.
I think there's still upside this year if you're getting it at 920.
Okay, well, that's interesting. Maybe you'll revise that target price as well. We'll see later on. But let's talk about M&A, mergers and acquisitions, because Golden Eagle, as you said, it does have a good cash position. Is it looking in to buy and merge and consolidate with other names? I mean, what are you hearing?
They're definitely looking at a few domestic plays. Right now, I think they're planning on 2 to 3 for 2010. Down the track, I think as this downturn created great opportunity because some of the domestic operators not having been strong in managing department stores are under a lot of inventory and cash pressure, and those are fantastic targets for strong players like Golden Eagle to take over. And Golden Eagle, with a very strong balance sheet, cash position, and a very good reputation in operating department stores in China, they're in the best position to do that.
Okay.
So I think they have a pretty good pipeline.
All right, Jessie. Well, let's talk about Lifestyle, which owns the Sogo department stores here in Hong Kong, also on the mainland, and the anti-sports after this break. But we are going to commercial. And afterwards, when Lehman Brothers went under, some Hong Kong investors took to the streets trying to get their money back on mini bonds. Well, some of that money is now coming back, but is it enough? We'll have more on the story after this break. Stay with us. For those that live here in Hong Kong, over the past half year, you've probably seen some pretty noisy street protests, especially here in the center of town. And that's because those Lehman mini bond investors, they're pretty angry. But yesterday, Hong Kong banks, they are counting the cost of their Lehman mini bond sales and wondering if the selling scandal is over yet. Paul Gordon is here with more. And Paul, I guess they're waiting for the fat lady to sing, but has she?
She has not sung yet, apparently. So you have to be a little sympathetic for the South China Morning Post, Susan. Here's a picture of the eclipse yesterday. The Post probably reckon they had their front page sorted with a big picture of the eclipse. And then, of course, the Lehman mini bond settlement came. So they have to share and have half and half. But that's the world of journalism. Now, Hong Kong banks offering to pay 60 cents at least on the dollar to buy back the notes linked to the now collapsed Lehman Brothers. The government says most will get at least 70 cents, and about 29,000 of the 40,000 people who bought the bonds are eligible for compensation. The chairman of the Allied Victims of Lehman Products says, "I can't agree and won't accept the settlement plan. It is not acceptable and fair to us." He says the regulator has let the banks get away with it too easily. That, of course, remains to be argued, but we do know some numbers now. Under the deal brokered by Hong Kong securities regulator, banks will pay about $813 million to buy back Lehman bonds. Investors, as I note, getting at least 60 on that. Darsing Bank said it'll pay $57 million. Wing Hang Bank said it'll pay $46 million. Those are the two latest numbers today. The territory's two biggest lenders, HSBC and Hang Seng, well, they pay nothing because they never sold mini bonds, and distributors Sun & K Financial said back in February it's going to pay the full amount. That's costing it about $11 million US. Now, Hong Kong has, as you noted, Susan, been protesting outside banks and government offices for months. An investigation by the Hong Kong Monetary Authority showed many of the mini bonds were sold to the elderly and the poorly educated and the mentally ill. Now, on a related note, a book to be published next month claims Wall Street banks had a plan to save Lehman the weekend before it collapsed. Wall Street Journal reporter David Wessel says 8 banks, including Goldman Sachs, Morgan Stanley and JP Morgan, agreed to put up $4 billion, with the Fed contributing another $6 billion. Wessel says that deal died when British regulators blocked a sale to Barclays. So there you go.
Yeah, you've seen those protests. They were angry and they were loud. They also posted pictures of the individuals at the banks that actually sold these mini Lehman bonds.
That's right, and they've joined every protest going. Just sort of tag along the back and wave your placards. It's been non-stop. It's been a very, very big story here in Hong Kong,
now,
as you know.
I have to ask you, Paul, if you bought into these mini Lehman or these Lehman mini bonds, would you take the 60% offering?
You'd have to look at the detail, wouldn't you? I'm not surprised that people want more, but can they get it realistically? I don't know.
Okay, I guess we'll have to find out. Thank you for that. Paul Gordon on the saga continuing here in Hong Kong. Now let's get back to our discussion on Chinese consumer stocks and talk to Jessie Chen from Macquarie. She's the #1 rated analyst on a few of these shares. And Jessie, we're going to take a viewer email at this point because we have one coming in from Elena. She wants to ask you, Jessie, about Golden Eagle, the stock that we were just talking about. Should I buy Golden Eagle shares now for a one-year investment?
Based on my target price, it looks a bit expensive, and I think there are potential better points to entry down the track. For one-year investment, look, there is some upside, but within the sector, there are cheaper plays. Look, right now the market, with the current liquidity level, is probably looking more at value plays, just chasing up the cheaper names.
Yeah.
So I think to be more concise, for one-year investment, you could probably find something with higher return. For Golden Eagle, it's really a longer-term investment, in my view.
Yeah, another one of your top picks then that segues into Lifestyle, which operates as Sogo department stores here in Hong Kong, also on the mainland. Do you think Lifestyle International is a better play? Is there more value in this stock than Golden Eagle on a one-year basis, if we're talking short term?
Yeah, it is cheaper. It's trading at cheaper multiples. I think it's trading up around 17 times 2010 PE. But also, in terms of growth profile for the next 12 months, Golden Eagle, we're looking at about 25%. Lifestyle in the high teens, so 17, 18%. Longer term, I think both growth upside will be stronger than the mass market players. So I think, yeah, correct. Lifestyle does offer, I think, better prospect in the next 12 months.
Okay, and what about its sales growth? Because according to our Bloomberg data, its sales growth actually lags its peers and also Hang Seng members, coming in at just, let's see if we can bring up just that 13% sales growth, compare that to its peers of 22%. Point of concern?
Because right now, Lifestyle, the majority of revenue is coming from Hong Kong, the Causeway Bay Sogo store. And Hong Kong was not as, obviously, as robust as the Chinese markets, and it's got sort of affected more severely. But longer term, or even just in the next 12 months, from a growth perspective, the main contribution will be coming from China. And Lifestyle has a large portfolio of very valuable properties as well. And within, just in the past few months, the company has made some arrangement to smooth out the store opening plan, which would help its growth profile in the next 12 to 18 months.
But it's also a high beta play as well, because it does play on the stock market recovery that we're seeing, and also, as you said, the property market also factors in. Is that something that we should be concerned about, considering the volatility that we're seeing in the markets?
The stock price has been performing pretty steadily upward, and I think, look, it is a high beta name in the sense that the Causeway Bay store sales is highly correlated with the HSI. But fundamentally, people now are increasingly looking at the growth potential from China, which is less high beta.
Okay, Jessie, we are running out of time here, but let's quickly talk about Anta, which is a sportswear maker that recently won the bidding to supply the Chinese team for the next Olympics. But it seems to be not in the high-end space, because it's known for its lower-end brands, that supply badminton and ping pong players. What's the outlook on this particular stock?
That's right. The reason we like Anta is purely from a stock selection process. Now, especially after the COC, the Chinese Olympic Committee deal, there's going to be structural change to the brand value, which essentially will drive sales growth upside as well as margins.
Okay, up 200%, 209% so far on the year. We'll see. I don't know how much more it has to run, but it's done pretty well already. Thank you for that. Jessie Chen